Hello, and thanks for joining us today as we talk about the balance sheet and how to use this important financial statement to understand the financial health and net worth of your business. Now, this is going to be a short video, maybe 7 to 10 minutes, but if you have further questions, if you want to compile a balance sheet for your business or further understand business finance, please reach out to your local SBDC. You can see some of the contact information below for more help in putting this together or understanding exactly what is a balance sheet and how can it help. So let's just dive in and take a look. And the first thing that I would mention is the balance sheet is one of the easiest financial statements to put together, but it's also one of the most important and it's one of the most overlooked. One of the things that I've seen in my practice is that not a lot of folks use the balance sheet tools, we'll say, in QuickBooks, or a lot of folks like to focus on an income statement or profit and loss statement. But a balance sheet is really important because it shows the overall financial health of your business. And this is critical. I tell people, the financial statement, the balance sheet, it's like an annual checkup with the doctor. And this is interesting because it really is. The balance sheet shows, is your business have a positive net worth? How does your business finance its assets? Think about when you go to the doctor's office and you get an annual checkup. You have to remember all of the decisions you've made about your health, your eating, your body, your exercise. All of that is cumulative in that checkup. If you smoked for 20 years and then exercised for 20 years, that one-day checkup shows the results of all of those actions, and that is exactly what the balance sheet is for your business. So without further introduction, let's just jump in, check out what the balance sheet is, and see the different pieces of the balance sheet that tell us information about our financial position. So the first thing to remember is that the balance sheet is as of a date, not for a certain period. And this can be a little confusing to some folks, but if you look at a profit and loss statement, a lot of times those are for 6 months or 3 months or for the month or year, whatever that might be. This balance sheet is you choose a single date. On that date, you look at what your company has control of, the assets that it owns, what your company owes, the liabilities, the debts, and then what is your net equity or your net worth is another way to say that. So assets, if you look at the top of the balance sheet, we first list all of our assets. These are the things that we own as a business, or let me just say we control as a business. So it's a little bit different because we may not own them outright. There may be loans against them, but it's still items we use to operate our business. So if you're an excavator, this would be the trucks and the machines. If you're a painter, this would be the equipment and the ladders and potentially the trucks. These are the things we use to operate our business. I believe the true accounting definition is something that we would control in order to realize future financial gains. It's a little bit fancy for where we're headed. So just remember, these are the things that we have, the things that we use within our business. And the first, the easiest, is cash. We just look at our checking account. If we have a cash till or if we have a safe, we see how much cash is there. If we have a separate savings, that's great. The other asset that is often listed with many businesses would be accounts receivable. So accounts receivable, they account for work that you've already done and billed for, but you still haven't received the money. We want to recognize that, right? That's an asset. Somebody owes that to you. It's a future financial benefit. Other assets you might see listed are supplies and equipment, inventory. Now here's what's important. What I'm showing you here is a very basic example. Sometimes you might have a list of assets this long, and that's great. You can sum them together. You can combine them into things like equipment or property, plant and equipment or inventory, but breaking them out isn't a bad idea to help you track what you have. Now here's where this video is going to differ from accounting rules and regulations. I advise my clients to always list street value, right? So if we had to get rid of this stuff in a very quick manner, not a fire sale, but what's the street value? A lot of the accounting practices will have you list things at at the cost. And I don't know that that's a good idea, because as a small business owner, you don't want to know what you paid for the truck. You want to know what it's worth tomorrow, right? If you had to sell it. You don't want to know what you paid for the equipment 15 years ago. You want to know what it's worth tomorrow. This shows us the net worth, the net equity of our business. So again, this particular business happens to have $75,000 worth of assets. That's, I don't know if it's good or bad. We don't know how much revenue they're making. But it does. And this would be, again, the value of the cash that you have, how much folks owe you as part of the invoices you sent, plus any other things you control. And again, what I'm showing you here just happens to be an example. You may have a lot more lines than this. So our liabilities are debt. And in this case, we've got some pretty normal stuff, right? We've got accounts payable. Now this accounts payable is what we owe people. So let's say you're a lawnmower repair shop. In that case, the accounts payable might be the parts that you've received, but you have 30 days to pay on those. You may have workers that have come in and worked, and you may owe them money at the end of the week. I think some folks get really technical and tell me that's wages payable. That's fine. But accounts payable or any other payables are short-term debts that you've accrued that you have to pay off very soon. You want to list those out as well. This business happens to have a credit card that it uses for business, a couple of those, and then some equipment. And you may have a note on equipment or a truck. Now, if you own a building, or if you have a mortgage against a building, this is where this would go. Leases are kind of a sticky question, and you'll want to have some help from an advisor, but some leases would be seen as debt. Some leases would just be seen as a monthly expense and show up on your income statement instead of your balance sheet. So this particular business, again, has assets of about $75,000. And then they have about close to $51,000 of debt. So what that tells us is, based on cash on hand, invoices that you've sent out, and the street value or today's value or resale value of the assets versus the amount of liabilities, right? What you already owe people or owe folks for things that have been sent to you, parts that have been used, or expenses that you put on debt, or it could be things such as an equipment note or a truck note. They have debt to the tune of $50,000, nearly $51,000. That tells us that this business has a net worth, we'll call it, or an equity value of close to $25,000, $24,358. So this is really good to do to see where your business is now. And there are many ratios that are available and industry standards that can show you, do you have the right amount of debt, right? What does your debt to asset ratio look like? Are if you're underwater, you want to know that, right? If you owe more on your assets than they're worth, that's never a good situation to be in. The issue is most business owners don't know one way or the other. So again, the balance sheet, a statement of financial position, not hard to put together, can usually be done in a half hour or an hour, but it's very important so you can see the financial position of your business. Please check in with the SBDC for some help with this. It's not really difficult if somebody walks you through it. The last thing I'll say very quickly is this isn't necessarily the value of your business. So don't think if you put this together and you come up with a net worth of $15, that's not necessarily the value of your business. That's a whole different video, which we'll come up with later. But again, understanding your financial position, your debt to equity ratio, what you have control over versus how much you owe, all extremely important, should be done on about a quarterly basis. That way you can understand the growth trajectory and the trends that you're seeing. I hope you found this helpful. And again, if you need more help, check in with your SBDC. Thanks.